What's the biggest risk to the equity markets this year? Could a rise in bond yields put an end to the recent highs that we've seen in equities? Let's now catch up with the Chief Investment Officer from Close Brothers Asset Management, Robert Alster. Robert, welcome. When we spoke to you at the back end of last year, looking at 2021, you were then fairly confident that we're going to see a year of two halves. First of all, driven and the continuation of the lockdown we've seen in COVID, and then as the vaccine kicks in, we get the benefit seen through in the markets of that. But I want to quickly catch up with you on this recent development with this rise in bond yields and whether or not it does actually put a big hurdle in the road for investors in terms of their options. Does this rise in yields, do you think, bring to an end this equity market rally that we've seen?
I mean, you're absolutely right. It's going to be the year of two halves, and the economic outlook is still very, very positive for the second half. But the bond yield rise is basically telling you that markets are worried about inflation, and they're worried about inflation coming through perhaps stronger, certainly than I or other people would have recognized in December. So the answer to your question, does it really inhibit the equity market rally, will depend just to what extent inflation comes through. Typically, when the bond yields get to the sort of 3 to 5% level, that's when equities don't like that. Under that, that's absolutely fine. And we believe that, yes, there's going to be a spike in inflation as vaccinations roll through and economies open up. But really, it's going to wash through. It's going to be like a ripple and not stick. And that's the crucial point. So, yeah, equities may slow for a bit. And if they do correct, we'd regard that as a buying opportunity.
What do you see as a correction? If they do correct, you say, what are we talking about in terms of worst case in your mind?
Mm-hmm. I mean, a correction typically gets defined as 10% or more. So, that could happen if there's some very, very strong data coming through. But the judgment is that, with a lot of labour capacity, with technology developments, you're not going to see the sort of structural wage cost driven inflation that some of us have seen in decades past. And so that gives you the buying opportunity in the equities that may have been hit, the growth type equities, the longer duration type equities, gives you the buying opportunity again.
Yeah, it's interesting you mentioned technology in that sentence there, because the tech side of the equation was the one that seemed to have sold out more than most as we saw yields rise. Do you think that tech on the whole is now too richly valued? I mean, clearly we are making big strides on the technology front, and indeed at the moment, and indeed the last 12 months or so, we've been using technology in order to communicate more than ever. Do you think, though, that nonetheless technology is overvalued at current levels?
The thing about markets at the moment is you've got to be discriminatory. You've got to look at each sector. So you take tech, but there's very many different subparts. And you're right, some of those initial public offerings that we saw in the United States did look very overvalued and went up multiple times. But some parts of tech, which are geared into the cloud, the infrastructure behind the future of tech as we know it, we don't think are and do have very, very good, strong, long-term structural benefits. The point being, though, is that when you get the recovery, when we come out of lockdown and inflation picks up, it's typically the value areas of the market that do well, the commodity sectors, the mining companies, etc. So what you're seeing is somewhat of a sell-off of those technology growth names while people rotate and fund into the more value-orientated areas of the market.
So what do you put at then the risk of seeing a correction, something around 10%? Do you have sympathy with those that believe that this is coming? What's the percentage chance of a market pullback?
I mean, it's very, very hard to give percentage chances. If, I don't know, push came to shove, I would say, evens, that there will be a correction. But what I'm really worried about is if, the inflation angle with very wage-pushed, longer-term structural inflation spiking out of control was going to come. But the other big point about this, of course, is that the Federal Reserve has lived through this scenario in the past, and they'll be watching and waiting. And, they've signaled already that at the moment, they don't think inflation is going to be a risk. So, it's everyone poring over the economic data.
One of the other things, of course, is we're mindful of what the Bank of England said recently. I think they said that they were expecting consumer price inflation to rise close to the 2% target by the back end of this year. Are you not worried about potentially this getting out of control? Clearly, the central banks have to make sure it doesn't get too richly valued, inflation. And if they do believe that's the case, they'll be putting up interest rates, presumably, which will stifle any growth.
Yes, absolutely. That is the bearish scenario. But remember, you've seen very high levels of consumer demand pre the pandemic, and we didn't get inflation coming through there. The technology, the pricing pressure, the fact there's very little union power, for example, compared to 2 or 3 decades ago, a lot of spare capacity still. All those things tend to suggest that inflation will remain under control. The markets may think it's coming back, but you have to ride through that. And I think the monetary authorities, the bank, the Fed, will wait and see on the sidelines. Remember, they need to make sure that the economic recovery and the growth really does take hold in order to drive economies out of this pandemic.
Okay, just one final question. That is how we should set ourselves up for the next part of the year, assuming that the vaccines do what they're expecting it to do, and that enables us to get out and meet again. Are you really heavily involved now in things that were beaten up so much like last year, like leisure, travel, and so forth, or are you preferring to go into those sectors that are going to respond to demand for resources, for example, base metal companies, the miners? Where is the keen sector?
Yeah. Well, as always in these sort of events where we have quite still a lot of uncertainty, right, in terms of what's going to happen, diversification is key. But you're right, yes, we have been moving more and more into those value-based areas because we recognized that a recovery is coming. But that doesn't mean that, we sold out of everything to do with technology, far from it. But at the margin, that's what's been happening. And yes, we have some of the natural beneficiaries, airlines, food retailers, etc., that are going to bounce back very quickly in the hospitality arena as we come out of lockdown. So it's about diversification across the portfolio.
What about geographical allocation as well? Are you still keen on the UK? I know we've been talking before about the undervaluation compared to other indices, other benchmarks. The UK seems to be behind the curve in terms of the amount of money it's been receiving because of Brexit and so forth, I guess, as much as anything else. Do you still like the UK over other developed countries?
Yes, that situation as regards the UK's attractive valuation has very much continued. So, yeah, we are looking at individual ideas in the UK to take advantage of whenever that value gets realised and those company share prices outperform. We've come back a bit on our US weighting, which was very technology biased, and we're looking as well at the emerging markets and Asia, sort of Pacific countries as well. They tend to do well in value commodity-based rallies. So again, it's about diversification, geography as well as sector.
Robert, we'll have to leave it there, but thanks indeed for joining us. That's Robert Alster from Close Brothers Asset Management, where he's the Chief Investment Officer. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.